Okay, this is Trading for Beginners who have never traded before, my series. This is number 6 in my videos, and this is some more of the trading rules. And so the next one is the rule that we have is no revenge trading. So what revenge trading is you go into a stock, and I've done this myself, there's other traders that do it, and what it is you lose out on a stock. So you buy something, it goes down, and you're angry, so you turn around and you buy it again, and you lose again, and you keep doing that, and then you realize, hey, it's going down. What I'm going to do is, I'm going to sell it this time. So you go down, you sell it, and as you sell it, it turns around and goes back up again. So you're not trading because of fundamentals, which is what the company is doing, or trading on technical trading, which is the indicators and moving averages and so on like that. You're trading just on your anger. So you're taking out your revenge on the stock, and the stock doesn't care what your feelings are or anything else like that. The stock is going to do what the stock is going to do. You have no control of it, so letting your anger get involved in the trading is going to cost you a lot of money. I had to learn this the hard way. The number of times I got angry and had a stock and revenge traded and lost a lot of money. So going along with that is what's called no martingales. So what martingale is, it's something that gamblers do, and you'll hear gamblers saying, oh, I never lose in Las Vegas, because what I do is if I make a $10 bet and I lose that $10, I just bet $20 the next time. Then I win and I get it back. And if I lose the $20, I bet $40. And then if I lose that at $40, then I just go to 80. Well, of course, what they've proven time and time again, because there's people researching on gambling and on the stock market, that eventually with martingaling, you will blow out your account. Whether you're at a card table, you will use up all your money martingaling, and instead of being in playing for a few hours at the gaming table, within a matter of minutes, in a matter of a few hands, you'll have blown out your account. Because going back to the 1 cent, 2 cent, 4 cent, like what martingale does, is eventually it becomes a sum of money which is more than you can possibly have in your pocket. So martingaling is a major rule, and it has similar to revenge trading. You're going to make your money back. And this works a couple of times, and I've done it and made my money back and everything else like that. I felt proud of myself and did it again and everything else like that. And then I martingaled to the point where I was just looking at what I was lost and losing, and I just finally had to say, hey, this enough is enough, and I stopped. Well, if I hadn't martingaled and I had just stayed with my original investment, I would have still lost, but my loss would have been minor in compared to what it was, because I martingaled. So that's a rule: don't martingale. This is a big one. This one is, there's all sorts of things, and that is do not listen to the news. And so you never trade the news. And when the news says something on an investment, it's going to go up to buy, or it's going to go down and sell, what happens is that move is already taking place. The news reports what has happened, not what's going to happen. So you sit down and you hear, like with the Robin Hood thing that I discussed earlier, oh yeah, the stock is going up, they're making all this money and so on like that, and the investment houses are losing all this money because they were short selling, and they got caught, and now they're so trading on that news. People I know jumped in and bought at $300 a share because, hey, it's going to just keep going up, and of course it didn't, and went down, and they lost over 2/3 of their money. if they didn't trade with a stop loss, of course. But most of these people didn't know anything about trading. They just saw this and they just jumped in, and of course that goes back to the fear and greed. Greed got into them, and so you never trade the news. So when they turn around and they say Apple is going to do this, and you're like, hey, I should buy Apple. The smart money has already bought Apple, and they're just waiting for the novice trader to jump in, drive the price up, and then they're going to sell when the price is up higher, and they're going to book their profits, and you get to take the losses. And so that's one of the problems with the news. The other thing is there's a guy that's on one network, and he has a real sideshow, and he rings bells and he honks horns and stuff like that, and he makes recommendations. Hey, you got to buy this, jump in, buy all this stock, as much money as you can put into it, or hey, the stock is going down, sell it if you got it and get rid of it today, and so on like that. Well, these large investment houses, not only do they have people that do the trading for them, they have people that do research, and they do things like what does phases of the moon do to the price of stocks. They're looking for any edge whatsoever, and there's actually investment houses that have tracked his recommendations. It's easy. They just watch the show, and he says he recommended you buy this or sell that, and they plugged all his recommendations in, and I believe he was on the air for about 20 years. He was caught in trading scams, so he's banned from trading for life. He can never buy a stock or sell a stock. He's just, that's what happens when you break the law, which he did. So he goes on this investment show and he's got his recommendations. So they plugged all his investments and tracked his investments over, since he started. And the computer comes back and says that the whole time, if you'd have followed his recommendations, your investments would have gone up 0.25%. So 0.25%. If you have your money in a savings account in the bank, you will make 0.25% per year. So 20 years, you would have made 0.25% for 20 years, which means you would have made 10%. So just leaving your money in the bank and not investing it, you would have made more money than listening to this guy. Does he have some home runs? Yeah. Does he have some major losers? Yeah. But averaged across the board, he only made in around 20 years, all he made was 0.25% on his recommendations. So don't listen to the news. Remember, the news reports what happened. They don't report what's going to happen. And that's basically the same thing. They tell you about a car accident, but they couldn't tell you ahead of time that there was going to be a car accident. They could take educated guesses. Oh, it's snowing and it's windy and it's raining, and so road conditions are not great, so there's going to be car accidents. But to physically sit down and say, we knew that there was a car accident, no. They report what did happen, and the same as the stock market. With the trading that was on Robinhood, the Robinhood traders, with GameStop, they reported what did happen, not what was going to happen. And people just guessed on what was going to happen and lost a ton of money. So it doesn't matter what the news is. If you're a fundamentals trader, which is earnings, your EBITDA, how much money did the company make. If you're a fundamentals trader, stick with that. Don't listen to the news. If you're a technical trader that trades based on indicators, moving averages and stochastics, just trade with them, but do not trade on the news. Now there's another thing, and of course I've got lots of these. It's beware of the pump and dump in investing. And what pump and dump is someone will buy into a stock. So they're normally the smaller stocks that they can't do it with Apple or with Visa or PayPal, stuff like that, the big stocks. It's normally with the lesser stocks that they do that, and they're able to move that, and the price moves. So what basically happens is they buy a whole bunch of shares in a company, and then they start putting out news releases, and once again it gets back to the news, not listening to the news. They start talking about how great this company is, and because they're buying stocks slowly as things go along, they're artificially forcing the price up with their plan. So they start sending out emails and things like that, and they start talking about, oh yeah, this stock is going up and it's going to go through the roof, and here's our track record. We made all this money on these stocks that we've recommended, which is true, they have. But the way they made the money is by scamming people, basically. So they sit there and they pump it up, so people start buying into it, and of course that gets back to the Robin Hood story that I discussed earlier. People see it going up and they're hearing about these things, so lo and behold, they start buying into it, and the non-savvy investor, including myself, I did it myself. I was in there a lot of times, and let's say it's a $20 stock, and they start, it starts going up, and of course you jump in, and by the time you get filled, the stock is not $20 anymore, it's $25. So you get in at $25, and lo and behold, the stock reverses and goes back down, and you turn around, and by the time you get your sell in there, because you didn't even have time to get your stop loss in, sort of thing, the stock's down to $20. So you bought in at $25, the stock drops to $20. If you're smart, you would have got out at a $5 loss, which is more than 10%. But if you did manage to get a stop loss in, you would have got out at 10%. But what happens is, since the people that are doing the pump and dump, they have sold their stocks at 25, and they have made money. When everybody else is selling, the stock doesn't go back down to 20. The stock goes lower, and a lot of times, it'll go down to, let's say, $15. So, I got caught in it, and by the time the stock went back down and I managed to get out, I bought it at 25, and I ended up selling at 15, so I lost $10. So those guys made money by pumping the stock up and then dumping it. And like I said, I've got these stocks in my portfolio. I keep a number of them just to show, to remind me when I look at them, hey, that was a pump and dump that burned me. And some of them, when that happens, the people are now leery of that stock because they saw what happened. They realize it was a pump and dump, so they won't invest in it. So what happens is the price of the stock gradually goes down. And of course, I've been in that situation where $15, I'm thinking, well, it'll go back up again and I'll make my money back. Well, it just keeps going down. And with my $25 example, I have stocks that are now worth $1 that I paid $25 for on a pump and dump scheme. So these companies are able to show that their recommendations, literally, they're not lying. They made all this money. But what they don't tell you is they made the money by pump and dump. Well, if they get caught and it can be proven that they're doing this, and it's called stock manipulation, then they can get banned from trading and so on like that. But it's hard to prove that, hey, we just made a recommendation, it wasn't pump and dump, we followed our recommendation, we bought in, so on like that. So you got to be aware of pump and dump. Now the other rule is you can lose 50% of your trades and you can make money, or you can win 80% of your trades and lose money. If you win big on the 50% of your trades and lose small, then you make money. But if you win small on your 80% of your trades and lose big on the rest, you will lose money. So this gets back to your stop loss. If you have a stop loss, it takes you out and reduces your losses. If you're Most traders look at, whatever their stop loss is. They look at a minimum of a 2 times profit. So in other words, if in going back to my $75 trade that I talked about earlier, I have a $7.50 stop loss in. That means my target for profit would be $15. It would be double that. So of course, if 50% of your trades you lose, and you lose $7.50, and 50% of your trades you win and you make $15, the math is easy. You're making money even though you're only winning 50% of the time. And the same goes for if you're losing large, like you're not using a stop loss, or your targets are too low. Even if at 1-to-1, you're pretty close to the mark. You would make money, but if you're not trading with a stop loss, or you're taking big losses because you're like, hey, it's going to come back, you can lose money. There's traders out there that actually will tell you that they make money, and the lowest I've heard any trader actually claim, and it's like when someone claims how bad they are, you better listen to it. When they say that they only win 30% of their trades and they lose 70%, yet they still make money, that's basically cutting your losses short and letting your winners ride. So, that's an important rule to remember. So when you're trading, you have to have a money management thing set up so that you're able to make money in the good times and finish off losing on the others. So I'll wrap it up here, and I'll get back into the next one with some new rules, or another rule, and some other things on trading and what you can do. So if this has been of value to you, please hit like and subscribe, and I'd really appreciate that. So see you in my next video. Thank you.